One of the most common questions we get asked in our Facebook group is about insurance. And a lot of the time, people will go directly to their super fund to increase their insurances. While the shoe can fit, often, and it's becoming more and more the case, that having life insurance, income insurance, and your disability insurance external to your super fund, set up by a financial advisor, is actually cheaper and the policies are better quality. So, on today's little YouTube exclusive, I'm talking with Trent Bacon from Skye Wealth. Trent is one of the advisors at Skye, and he's going to unpack a case study for us and just explain a couple of things. Welcome, Trent, to the podcast.
It's great to be here. Thanks for having me.
My pleasure. Now, conceptually, before we, get into the case studies, can you just let us know how you can actually get your income insurance or your life insurance set up through your super fund and not have it as part of the super fund?
Yeah, so how they're doing it with the insurers these days is you're able to fund your insurances through your super fund, but you technically hold a super fund with that insurance company. So
Right.
your investments will still stay with wherever your super fund is with the time. If you want to put more money towards that super fund, you will. You'll use it there. Your employer will still put money towards it. As I said, your investments will stay there as well. There's other super funds purely there for your insurances. So what happens on an annual basis, that insurance company will say, we need $1,000, whatever the premium is from, and ask that from your super fund. That money will transfer from one super fund to another, sit there and pay for your insurances, and the same thing will happen next year and every year after that.
So that realistically means the super fund that the insurance company sets up won't have any investments in it or anything. It's just a shell and it's just got the insurance in it.
Yeah, correct. So there's no extra. What you'll talk about is having two super funds with extra admin fees and things like that, and having your investments across to it. It's not the case. It's a very common question we get. That's set up as a shell. There's no extra fees outside of the regular insurance ones and everything that's already listed. So
Yeah.
you're good to go in that factor.
So you guys can set that up with whatever insurance company. Do all insurance companies allow you to set up this shell or the super ownership?
Yeah, every insurance company that will be able to recommend to you will use that. A lot of your direct insurances won't be able to do that, and you won't be able to do that directly through with the insurance companies either.
Right.
So that's a thing that you'll have to seek an advisor for.
And in theory, if you've got your super fund with Australian Super, ART, Aware Super, CBUS, whatever, you can set it up so that stays there. Your employee contributions going to there, has all your investments, but the insurance policy that you set up, it's in its other fund, and each year it automatically pulls the premium across.
Yeah, correct. So there's a form you'll fill in when you're doing it that will allow, it's called an enduring rollover, that basically allows it every year. So if you're on holidays one year and your insurance premium's due, you don't have to do it manually. It's not something that
It'll
you have to,
automatically
it'll
take it.
automatically happen. There's only a few super funds that don't allow it, and there's some funky government ones. But yeah, for 99% of Australian super funds will allow you to do it this way. And if you decide that your investment super fund isn't for you, and you decide, perfect, I want to go somewhere else because they've got better investments or whatever you come up with, you will just need to let the insurance company know, hey, this is where my super's with now. Can I refill in the form and say, this is where I need to take the premiums from? Rather than if you had your insurances within your super fund, you're looking at redoing your insurances, and that comes with all different myriad of stuff.
Yeah, so effectively, if I set up my death and disability policy through you guys with an insurance policy that's wrapped in super, I could, in theory, every 3 years change super funds and just tell each super fund every couple of years that I want to change it and suck the money from the new one that I've got.
Yeah, in simple terms, basically they're just using it like a bank account.
Yeah.
Where's your money being held, your super money being held? Where can we take the money from? And as long as it's one of those 99% of funds, we're good to go.
Yeah, cool. Now, when it comes to the, and this is the whole thing, a lot of people go direct to their super fund to get insurances. What are some things that could lead people awry when it comes to, I'm with this super fund, so I'm going to go to them for my insurance directly?
Yeah, so things you're potentially going to miss is the level of cover. Getting that right is your first one. The different features and benefits that you may miss out on. So there is multiple different features and benefits you can't get through your super fund. Trauma cover being the main one. They're unable to give you that product. It's only going to be through an insurance company. Other things, that notion of being locked into your super fund is another big one.
Mm.
And then the medical side of things, making sure that you're going with the right insurers. So each of the super funds have an underlying insurer within that, where that's going to be one insurer. They may have some different rule on what your health is, where there's multiple other insurance companies that may use something completely different and be able to have your policy exclusion-free, loading-free, which is something that an advisor will be able to help you out with.
Yeah, so if I've got an Australian Super or ART or an Aware Super fund and I go to them directly, there's only one insurer there they'll insure me, yes or no.
Yep.
But if I had a medical condition that they won't insure, there could be another insurance company out there that an advisor can set up for you that will insure you.
Yeah, and that's one of the main things we'll do, and a lot of advisors will do is look at your health first and foremost and figure out which insurance policy is potentially going to offer you the best terms. Is there certain things that, we're going to get covered for some place, but not covered for the other place? We're more likely to go with that one that's going to cover you.
If I've got an existing super fund and there is cover that's just given to me for having the account, it might be $300,000 death cover, might be $118,000 disability cover, and $700 a month income insurance. If I went to you guys and I'd since broken my arm or my elbow and I couldn't get cover for a new policy, what do I do?
Yeah, typically we'll probably look at keeping that policy and going, well, if something happens to your elbow again and you're unable to work, that policy is probably likely to pay you out. So what these super funds will do is they'll give you cover exclusion free. As you said, very low levels of cover to basically get you through the gate, and then hopefully have you increase it in the future, where we'll go through a bit later. It'll drive the price right up. But that level of cover, we're probably likely to keep it and take out extra cover elsewhere to bridge the gap that's going to be there.
Okay, so talk us through a practical example.
Yeah, so we've got a couple of practical examples here, and then we've got our overall data that we put together last year. So this client here, 44-year-old female, working in admin. The current super provider is the Australian Retirement Trust, and we're looking at life, permanent disablement, and income protection for this client. Noting before we mentioned that trauma cover isn't available within the super policy, so we're trying to make it as like for like as possible. So for this client, we're just under $1.1 million of life cover and the same permanent disablement as well. That same definition for permanent disablement and income protection policy at $4,375 per month. Same waiting period, 60 days, and an age 65 benefit period. So you can see in the left there is our super fund, which is Australian Retirement Trust, comes in at $6,676 for the year.
Jeez.
Our retail insurer comes in at $2,720.
But isn't it cheaper to go to your super fund?
That's what the myth is. But we've got a lot of data here that says it typically isn't once you actually start increasing the cover to reasonable levels. And $1 million for most people isn't overly over-insuring someone. You think about a mortgage and some income that's left behind if you pass away for your family. And your income protection through to age 65 is usually something we like to look at.
Yeah, gosh, that's amazing.
And the last line there as well is our feature score. So the feature scores are ranking out of 100 done by one of our programs or that we use to compare the insurances. Closer to 100, the better. It's not the be-all and end-all, but the higher the score, the more likely you are at having better features, more likely getting paid out at the end of the day.
Gosh, that's wild.
46 versus 82 there.
Yeah. Okay, let's have a look at another example.
Awesome. So this one, age 31, an accountant. Their policy is with Australian Super. Same again, life, permanent disablement, and income protection. This time we're going a little bit higher in our sums insured, $2.219 million. And keep in mind, these are real life clients that we've pulled out and just de-identified them for this purpose. Our income protection at $9,742 per month, a 90-day wait. When our retail insurer, we're looking at a 60-day wait. So we're looking at a shorter waiting period. So it means this person's going to get paid out 30 days quicker if they're unable to work than the Australian super policy is. As you can see there, it's $3,464 per year for Australian super and $2,161 from your retail cover. And you're going to get your money 30 days quicker if you're unable to work.
Far out. It's wild, isn't it?
Yeah, it's a big difference. And most people obviously if you go directly to your super fund, you're not really getting a comparison from anyone else. So
No.
how would you know?
Yeah, you got one insurer that they're giving you the price, but if you go to you guys, well, here's 3 or 4 or 5, and it's actually night and day cheaper. And that even and the financial advisors, you guys even get paid through that as a commission, which is not an additional cost out of pocket. The insurance company will pay you guys.
Yeah, so most advisors will charge a relatively small upfront cost to do the advice, but everything else after that is
The
born
implementation of the advice.
is born into the cost there. So there's typically no extra cost on top of that for you to actually take out that policy.
Wow.
So what we did last year, we took 500 clients, 500 of our last real clients from, I think it was maybe Easter last year and backwards.
So pretty much from April, March 2024.
April, March 2024 was, that early part of 2024. So 500 clients. What you'll notice here is it's only 421 clients. That's because 79 of those clients ended up being or had a super fund that was less than 5 that came up. So we kept them off the data to make sure that there wasn't any large outliers or anything like that. So what you'll see is overall, the group insurance is 38% more expensive when we're looking at the levels of cover that we actually recommended at the time of the advice. And you'll see at the top, the ones that are more expensive when we're comparing them side by side. So you've got CBUS at the top, all the way down to one, which was actually cheaper, which was Aware Super. Of the 43 cases we looked at, which is one of our more higher ones, they're actually 15% cheaper.
Is that for all occupations or just for your clients?
That was just our clients. So we looked at specific cases that we had. So there might be an outlier of, there were more admin people or more blue collar that came up beneficial for that specific super fund.
And I think that's the benefit of going to a financial advisor. You guys will have a look at everything. If the cover is best left where it is or increasing Aware Super, no sweat off your sack. You guys will set it up.
Yeah, for sure. So if we think it's in your best interest to keep that super fund and keep the insurances that are in there and then again, increase it, we're happy to recommend that. We'll come up with the reasons why. It'll be around your health, the price, the different features, and go from there.
Now, if someone wants to reach out to Skye Wealth, we'll put a link in the comments below. What's the process? Can they just have a bit of a 15-minute discussion to vibe out what the process is? How does that work?
So what our process is you'll click on the link below or reach out to us directly and you'll book in a 15-minute phone call with one of our advisors. So at a time usually that suits you. We'll go through what your scenario is, what you're looking for, and answer any questions that you need before committing to going ahead with insurances. We'll happily say that, hey, you're not the right fit for us at this point in time because of X, Y, and Z if that's the case, but most of the case we can help you out. From there, you'll fill in our fact find. That fact find will contain everything we need from your personal details, your assets and incomes, liabilities, expenses, your work and your health details. And from there, we'll then engage the insurance companies and go, we have this client with XYZ health.
Yeah, so you send a bit of a blind pre-assessment to all the insurance companies. So if it's here's this client, and it's me, for example, he's got a bit of high blood pressure, a little bit overweight, is office role, what are the expected terms that you would offer? Is that how you do it?
Yeah, so basically we'll take everything out.
Shop the market,
take out the identifying features. So if it was Glen, it'd be Glen, age 21, office worker, and away we go from there. And the insurance will come back and say, we're expecting to do this exclusion, this loading. Hey, we need this more information before we make a decision.
Yeah.
Then we've got the whole market.
So you've got a whole team that just does the pre-assessment stuff?
Yeah, we've got a whole team that just does that and collects the data. So you'll hear from them in the process.
And then so basically on balance, if there's 8 or 9 insurance companies that you might have access to, how many is there?
I think there's about 9.
9, yep. There was 11, but there's been some consolidation in the industry. You will effectively say, okay, we've got all these things. These 3 companies here will give us the best terms medically. Then you'll look at price and then kind of present those options to your clients.
Yep, all whilst looking at your super fund cover as well.
Of course.
Make sure that what we're doing with that is, top of mind. And then, we're looking at price after that and figuring out, hey, we might come up with what our recommendation is and it might be more expensive than the cheapest insurer. And then we'll have our reasons in there going, we recommend going with this cover because it's going to cover you for these 2 illnesses that this other insurer is not going to.
This insurer here could have a testicular cancer exclusion, where you can pay a little bit more over here and they won't exclude that condition.
Yep, for
Sweet.
sure. So probably one of the big ones is actually family history of breast cancer.
Right.
So there's a couple of insurers that are pretty good with it in terms of being willing to cover you for it, and a lot of the other insurers aren't willing to do so. If either of your siblings or parents have had breast cancer in the past.
Yeah, sweet. Well, there you go, everyone. Don't believe me. Look at the data. It's there. On balance, you will get a more cost effective policy. You'll get one that is rated higher in terms of bells and whistles and definitions. Going through a financial advisor and having them set up the insurance for you. Not only that, I'm unashamedly, or however you say it, I am pro financial advisor. You know, not only are you looking at the structure, you guys are looking at the tax efficiencies, the estate planning concerns as well.
Yes, that's all a part of it. We're making sure that you're not going to get a permanent disablement payout, and then actually 20% of that's going to get slugged off to it. So we're making sure we're including that. If there's estate planning stuff, we'll consider that too, and making sure that if you're a high income earner and you've got lots of money going to your super, we're not breaching those contribution caps, and making sure that we've got enough money going towards your super.
So in theory, if I needed $1 million death cover, and I had a family on the side that my main family didn't know about, could go with me, Trent. Don't be like that. It's 2025. I could, in theory, set up one $500,000 policy funded from my super with my family A as a beneficiary, and a second policy in its own super fund, even with a different insurance company, with my second hidden family as a beneficiary. So when I check out, the money goes exactly to my two families, and they'll be able to meet each other at the funeral.
Yeah, typically yes. A couple of different binding nomination forms. You could even do the one policy, but
I know we want to keep it separate.
But I know you want to keep them separately.
We want that second family to have its own mailing address, its own email, and hidden away. But there's flexibility.
There's plenty of flexibility. Whether you want to leave it in a trust for your children as well, that sort of stuff. It's figuring out now you've got your insurance in place. Is making sure your estate plan's ready as well. Like
Perfect.
This money will land in your bank account and it's landing in the wrong spot for maybe 2 or 3 year old children. We need to have it set up in an estate. So seeking professional help for your legal stuff is definitely something we want you to do too.
Awesome. Trent from Skye Wealth, thank you so much for joining me today. And I just want to encourage anyone, if you do want to get your insurance set up, I believe it's a core foundation of your financial life to have your income insurance sorted, your death cover, your disability cover, and your trauma insurance. Factor that into your budget and your spending plan, then get on with your life, because all the investing that we do is predicated on money coming into our bank account each week. And if you couldn't work again, if you couldn't work for 6 months, we want to make sure the money doesn't stop and we don't have to sell down assets. So, Trent, thank you so much for joining us today.
No worries. Thanks for having me.